We've covered the banking crisis and the prospect of central banks easing back on rate rises in the very near future. There's just one thing. Normally, when there's any hint of interest rate rises ending or even falling, share markets and property pop. But not this time. In the past 6 weeks, the Australian stock market is down almost 8%. Commonwealth Bank shares are down more than 12%. BHP by almost the same. For further analysis, I caught up with Catherine Allfrey, Principal and Portfolio Manager at WaveStone Capital.
As soon as we get interest rates, any sign of peaking, usually gold, off it goes. And so we are seeing that. And it's also a flight to quality. Of course, we've had the banking crisis on both sides of the Atlantic. And so investors are very spooked by what that means. So far, it's been a liquidity crisis, clearly, in the US. We don't have any issues here in Australia, I should point that out. But overall, there is an impact in terms of Australia, in terms of the cost of funding for our banks. So that's flowing through. OK, just to pick up, because we've talked about this on the program already, and that is, at the moment, it seems to be the banks that have got into trouble have had a mismatch of assets. They've bought long-dated bonds or been in the wrong areas, and it's the pricing of those that's actually caused their crisis. It's not what is a normal situation when interest rates rise, that there's credit qualities, question of credit quality, companies going broke and so forth. That doesn't seem to have been, at least until now, the problem of banks and the problems of the stock market. Yeah, the problem in the US is that the banks have been, in terms of their assets, what they were invested in, because they obviously had a loan portfolio, but they also had invested in bonds, and those bonds were in commercial real estate and in mortgages. Unlike Australian banks with their investments, if they invest in government or semi-government bonds, so very, very safe assets. So the market got spooked. You know, there is an issue at the moment, bit of a zombie US office sector. People are a little bit concerned about the credit quality of that sector, and clearly those banks were holding some of those bonds in that commercial real estate. So there just wasn't safe bonds that were backing those deposits. Hence, we saw the run on those banks. OK, so go back to the start of our conversation. Interest rate rises, if they're not at an end, they're coming to an end. Yeah. Normally, that would mean that the stock market goes, hallelujah, we're off to the races, and suddenly you see it start to move because they can now see the peak of where the funding crisis is. But that's not happening because for some reason there's some concern or fears about the global economy and whether, in fact, there have been too many interest rate rises. There also is concern because, you know, Powell said this week that, you know, inflation has been quite sticky, right? And the Reserve Bank's saying the same thing. And so instead of interest rate cuts later in the year, you know, it's more sort of pushed back in terms of rate cuts. And so, you know, that's what the market wants to see. When is the first rate cut? And that hasn't happened yet. OK, so normally, though, if you saw BHP shares down 12%, if you saw Commonwealth Bank shares down 12%, you'd have investors chasing the yields off those stocks. You'd have investors chasing the opportunities that might come. It doesn't really seem as though there's an appetite to take on that risk at the moment. There's been the classic de-risking of investment portfolios. Yeah, there has, but you've got to remember that CBA was at an all-time high up at 110 and, you know, BHP was up at $50 and, you know, people were buying the China reopening story, and that seems to be wound back a bit in the last couple of weeks as well, with concerns over global growth, right? So, you know, that's why, and the market is sort of cautious, you know, because the effects of this interest rate hike plus the liquidity crisis that we've seen across the globe is like a credit tightening event, right? So things are going to break. And so people are worried about the impact on the real economy and what is going to happen. And so equities tend to sort of sit back and say, right, you know, we're concerned about this. We need to price this risk properly. And that's what we've seen over the last few weeks. OK, so in your assessment, what breaks? Well, it's anything that's leveraged, right? Anything that's really leveraged. And so unfortunately, you know, we've seen it in terms of Credit Suisse. That was sort of effectively an insolvent bank, had been a slow-moving train wreck for some time. That's been obviously parked, and, you know, UBS have got the deal of the century. But then you move on and, you know, you see it in the US in terms of the amount of leverage that is there. And here in Australia, where we're going to see it is clearly consumers are feeling it. House prices are down, you know, and their mortgages are going up. And so we will get, you know, a real effect here in the consumer side. You mentioned it earlier, the commercial property sector. Yep. Now, clearly,
many parts of that in our CBDs, they have not fully recovered. Companies are taking less space than they previously were. I'm just wondering whether in the United States, around the world, here, that's a sector which is generally highly leveraged that could very well be a pressure point into the future.
Definitely in the United States, they haven't returned to work like we have, right? And their cities, unfortunately, are full of a lot of crime and a lot of homelessness. And so there are a lot of zombie, real estate assets in the US. Whereas in Australia, obviously, we're maybe 70, 75% return to work. We have, clean, safe cities. And so I don't think it's the same extent here in Australia versus the United States. But clearly the United States has a problem. The only flow through, unfortunately, is capital is global.
That's right.
So the pricing of those assets is done, globally. And so, unfortunately, that's what you've seen is a repricing of our property sector here as well.
And that generally would affect our banks as well because they have to go global to actually get their excess funding that's not in the deposits. And as you point out, deposits do now move very, very rapidly. Yep. But they've generally done pretty well in getting their funding for at least the next 12 months.
Yes, exactly. I mean, the Australian banks have been, telling investors in the last couple of weeks, look, we're pre-funded a lot of our funding over the next 12 months. And just reminding investors that, unlike the global financial crisis when banks were 50% wholesale funds, and 50% deposits, now there's 70% deposits. So we're in a much stronger position now than we were in the GFC. And so the 30% reliance on wholesale funding, they do turn to do it long term. Commonwealth Bank is out 5 years. And so that is actually, a positive for that sector.
And it's a strength of those banks. OK, so then as an asset manager, bring it all the way back home. Right now, given the fact that markets have settled in the way in which we've described, are you out there looking for bargains, looking for opportunities, or are you basically sitting on your hands because you're concerned about what happens next?
No, we're never sitting on our hands. We're always looking for bargains, always looking...
Are they out there?
Well, it's interesting too because this week we've started to see the first of the equity raises. So we saw, National Storage come out and do a capital raise. So those are opportunities. You've got to have plenty of powder, plenty of cash in your portfolio to take, those opportunities as they come through. We saw Kelsian the week before, buy a business in the US. And so we are selectively picking stocks from that perspective where we see a bargain. But on the main sectors in terms of financials and energy and materials, we're underweight. We're quite defensively positioned in terms of, owning stocks like Woolworths and Transurban. So we're quite, comfortable where we're sitting relative to the market. And so we're just looking for bargains, like you say. OK,
but we haven't quite clearly seen the worst of the consequences of the big increase in interest rate rises here. So consumer-facing businesses still clearly have headwinds into the future.
Yeah, we're seeing it in New Zealand. They seem to be 6 months ahead of us. And this week we actually had a profit warning from a group called Warehouse. And so that was quite nasty in terms of, the consumer outlook over there. And we would expect, not yet, but in this back half of this year, we'll start getting some, quite soft and weak consumer numbers.
And there's one other final aspect of this. Go back even 18 months, 2 years, sitting on cash was sitting on a zero return.
Yes.
Right now, sitting on cash is sitting on a 4 to 4.5% return.
Yes.
So there's a slight difference in your ability to be able to sit on that cash, I guess.
Yes, exactly.
And so
we're being paid for that.
You're being paid for sitting on that cash right now. It's very good. Catherine Allfrey, it is always great to have you on the program, and many thanks for your time today.
Thanks, Ross.